Good evening, everyone. Welcome to Policy Commons by the Indian School of Public Policy. It's a dialogue series where we bring together samaaj, sarkaar, and bazaar on the same platform to discuss public policy issues. I would like to extend a warm welcome to all our panelists for joining us for a discussion on Indian business and banking reforms in India. We have Dr. Susan Thomas, Research Professor of Business at Jindal Global Business School. Her research interests are in financial econometrics and market microstructure in India. Her engagement with markets include designing the stock market index, a real-time risk management system for the clearing corporations. We have with us Mr. Sanjeev Pandey, Deputy General Manager, NCLT and Policy at Stressed Asset Resolution Group at State Bank of India. He has 35 years of experience working with SBI in different assignments such as commercial banking, project finance, restructuring, and rehabilitation of weak units under BIFR, CDR, and IBC. We have with us Mr. Sunil Mehta, Non-Executive Chairman of Yes Bank Limited and Chairman and Managing Director of SPM Capital Advisors Private Limited. He has 40 years of leadership experience in banking, financial services, insurance, and investments with leading global and domestic financial institutions. I would also like to thank Mr. Abhizar Devanji, Partner and Head Financial Services at EY, for joining us and moderating the session today. He has been a thought leader in the financial services and distressed asset space. He has extensive experience in assisting buyers and sellers of businesses in evaluating risks and opportunities of the intended transactions. Audience member, you're welcome to ask questions at the end of the session. You can also type your questions in the chat box, and we'll see if we have some time, we'll take up those questions. I would also request all the audience members to be please on the stay on the mute mode while we are in the session. Over to you, Mr. Devanji.
Thank you, Nidhi. What promises to be a very interesting panel. Everybody's name starts with the alphabet S for some reason. And I hope we will have a lot of sanity added to this conversation today. The way I wish to conduct this today, with the permission of all the panelists, is that I have one large question for everybody after a brief introduction. And thereafter, we have some other topics which we could take up, all related to policy. Thereafter, we have a 15-minute Q&A that I planned, Nidhi, which I would appreciate if you could take the lead on in terms of accumulating questions and then coming up. What I would appreciate is for the audience to keep raising the questions as we go along in the session and noting down their points, because some of them may be answered during the course of this panel. And thereafter, we will take some holistic questions, and 15 minutes have been allocated for it. So with that, I would like to start off this thing with a brief introduction. Now, India has had a unique problem within the financial services sector, and I particularly talk about the lending part of the financial services sector. And we've had the slowest growth in credit in the last decade compared to the other decades. And the other decades were times when India was a decoupled economy, or at least we thought we were a decoupled economy until 2008. Even when the world fell off, India's credit growth was a staggering 20-23%. And we had lots of investment happening in infrastructure, in asset creation. We were on a very good growth trajectory. And that continued well until 2012 and 13, when we had a host of CDRs done. And thereafter, we had Dr. Raghuram Rajan take over the RBI, and at some stage kind of burst open a Pandora's box. And that resulted in a fair amount of NPLs in our system, and that slowed credit growth. And tremendously, because the NPL levels rose quite significantly. Banks got cautious in their lending. Coupled with that, we had a phenomenon called ILFS. And that was also inadvertently a bad credit decision, so to say. And that had another large implication, is that wholesale credit flows to the NBFC sector almost vanished. And we have that problem even today to such an extent that we are out here discussing whether NBFCs are structurally viable for wholesale credit. So on the one hand, while we have IIFCL and we're setting up an infrastructure bank, on the other hand, NBFCs are almost not able to lend to infrastructure since ILFS. So we've had a fair amount of, slack in our credit growth. Asset creation has stopped. Credit flows, corporates have gone and deleveraged over a period of time. Working capital is generally not available. Sectors like real estate, sectors like construction have actually become taboo. Infrastructure lending is more or less to a halt. So we're now seeing a situation where we need to figure out, are we policy constrained? Are we balance sheet constrained? Why is credit growth not happening? And what I want to do is today's discussion around policy. If we can focus around what policy changes are required, what fundamental changes are required, whether in the asset creation or the credit growth point part of the business, or in the asset preservation or the recovery part of the business, and what can we end up achieving with those. Because India clearly, if it has to maintain the momentum of the credit growth, the GDP growth that we're talking about, we have to do a lot of credit underwriting. Credit in the last decade, for example, averaged around 10.5%, compared to the nominal GDP. And it's quite terrible because except for the year 2018-19, for some reason, we've had a terrible credit growth. That's because corporates have delevered. I know people who have kind of said that we don't want to go back to the credit markets again because of the problems that they would have faced in recoveries and the skepticism that bankers have had over time with them. NBFC credits is completely stopped. NBFCs were doing a lot of leverage work and doing structured finance of their balance sheets. That has stopped. On the other hand, something outside of the banking system is starting to emerge. I won't say it's a very big market as yet, but it's starting to emerge. Is the private credit market. And on the private credit side, through the AIF structure, we are seeing a lot of flexible credit being available now. And the hope is that a lot of the work that was earlier done in the NBFC structure would actually move to an AIF structure. So it does not really impact the banking systemic risk structure at all. So, of course, I have said enough, but I would like to turn my attention to our panelists today. And my first question is to Mr. Mehta. So, the topic I would like you to speak about is rethinking resolution. Because we've had a time when, we were gung-ho about NCLT. We had the first 24 companies come in. Some of them succeeded because of the business cycles. Others succeeded because they were possibly better managed. Then we had a situation where NCLT recoveries completely dripped out. And we had a lot of issue and we said, okay, what do we do? Earlier than that, CDR was very rampant. And people thought that CDR was something we just kicked the can down the road. Then there were a lot of initiatives. There were policy regulations that came about through the RBI. They came out with a number of acronyms, S4A, SDR, whatnot. IBC was the regulatory thing. SARFACI was already introduced, but a lot of it picked up as we went along. CDR completely stopped, but the June 7th circular came about from RBI, and that facilitated a lot of restructuring. We tried to create institutions, the Bad Bank, Shashakt, and many of those institutions. So I would like you to know first of all, where is our thinking today? And what do you think are the key rethinking we need to do as far as stress is concerned?
Thank you, Abhijit. Before I go to your specific question on the recovery piece and the restructuring, if I could actually spend a couple of minutes just on the preamble that you sort of placed before us is on the credit, the entire evolution of the credit growth and what we've seen over the last, I would say, about 10, 12 years. Structurally, we had a problem. And we never addressed that issue for a long, long time. As long as there was adequate liquidity coming out of the banking system to support the growth of different sectors, including infrastructure. The excess liquidity in the system that was available post-2008. And we saw India's own GDP growth growing at a strong clip, enabled the bank to sort of move in this euphoric state of a lot of liquidity flowing into the banks, and of course the banks having the pressure to redeploy it. And that's what was a big issue. The financing and the credit growth that was being extended largely to infrastructure, to real estate, and many other sectors which required long-term funding. The system did not look at several aspects as to what were the risks that were really building that. The first was the whole aspect of the credit assessment itself. From a risk perspective, are we in a position to look at those projects 10, 15, 20, 25 years from here on and do the entire sensitivity analysis to ensure that there is enough cash flow that will come out from the projects that we are financing. So you had domestic financial institutions that were earlier much more competent to do that. That then fell on the lap of the large public sector banks. And then you created some skill sets in SBI caps that was a kind of an extension of where this was being looked into. But the decisions were really being made on the financing of those within the banking system, following predominantly what SBI cap as a leader who was sort of looking at this in the marketplace. And I think the independent evaluation that should have been done with in depth of what is the risk portfolio that we are building and the individual credits, and then the asset liability mismatches that were sort of building in the system. I think all of these and plenty more were kind of getting accumulated, but we never looked and addressed those in a granular fashion to make sure that there was orderly credit growth that was building up. Yes, we felt proud that we were financing large projects and providing that support to infrastructure and providing growth to India. But I think intrinsically, if we had sort of looked at below the bonnet and seen what the car was moving at a rapid pace, but was the engine heating up inside, and where was the challenges in the engine that was sort of, I think that was really where we were running at a huge pace, but not looking at where the systems were actually breaking up. And then, of course, the story is sort of.
So what was the constraint? What was the constraint in raising long-term money to meet the mismatches?
I think that the constraints, Abhijay, was sort of well known that you had financing through deposits that were coming in. There was no long-term funding, even in the debt market. We all knew that there was an inherent issue in the domestic debt market. We never created a long-term debt market. And that was not really on the asset liability mismatches. How could the banks finance 20, 25-year-old exposures with an intrinsic maximum maturity of deposits that they could take and other bonds that they could issue with an average maturity of a duration, let's say, anywhere between 5 to 7 years of their liquidity? Now, that's one piece. The other aspect is on the governance structures that we have for us to kind of take independent views on what needed to be done in deciding certain projects and the exposures. And we could spend more time on that as we move along, because that's a very fundamental issue in the way we were structured. And there is no policy issue in that. It's a question of how we were structured and then how we were implementing this. I mean, most of the banks are listed entities. They are under the listing guidelines and the regulations that they have to follow. But how did we implement those? And there is some issues in the way the statute are framed on the PSVs and the SBI Act, which needs to be re-looked at now as we move forward from here. So that's on the element of this credit issues that develop. And then we identified those credit issues. We found that we were sitting on a huge stress asset platform and a portfolio. And then we sort of came up with those various solutions. You just named all of them, and none of them truly worked. So then you had the IBC that sort of came into place. We recommended the Sashakt report, and now you have the some restructured version of that as the NARCL. We had said that that should have been completely private sector, a solution that should come in through private funds, not predominantly private sector funds, but not state-owned. But now, anyway, for good reason, it is a state-funded solution that is being sort of found that should be more a way of moving forward on this. The IBC certainly from a recovery process, certainly for the first 10, 12 big assets, which were valuable, which certainly got the price that they deserve. And I think that sort of set the momentum, which was good. People recognize that that is the right way to go. And it obviously created the right kind of a construct for these assets to move forward from there because of the regulations that they sort of support that they provided. I think the issue really is that was there enough capacity that needed to be created for that to be followed on, because there was a lot of clogging in the system and hence the momentum dropped from there. We also need to look at from a recovery point of view that our entire asset reconstruction companies that were there, were they undercapitalized? Now we have the NARC. Are we sort of now becoming an enabler for many more of such ARCs coming in with private capital? You spoke about the AIFs supporting this. I think the solution is not one, Abhizar. There will be many different constructs that will sort of emerge as part of the recovery process. The total value of and the quality of the assets that have got there for good reason or bad reason, these are national assets. These are of value to the country. What has also emerged is that some of these assets, as they move from the banks to the ARCs or AIFs or to new holders, have not been properly priced. So there is a lot of arbitrage that has been there. And I hope at some point we don't look back and see that there has been a mispricing and hence certain institutions have lost out. So I don't want to say, but is there a gaming, will there be a gaming of the system in this entire process of recovery? I think we've got to be very watchful of that. And we've got to make sure from a policy perspective that we have checks and balances to ensure that we don't have a look back and then we are sort of again stalling what should be a very good recovery process from here, because there will be people who will be sort of pointing fingers as to what really at what prices have these assets moved. So there's a lot of work to be done on this till we move in a seamless fashion, that our recovery processes are moving well. There is money that is coming in from domestic institutions, private institutions, global funds, to put more taxpayers' money through more PSPs or state-owned institutions into this, I think would be probably the wrong way to go, because this has its own challenges on the way you can actually seamlessly work on from a process point of view. But I'll stop here. I think there's a lot of new innovation that is being done, and you will see that over the next 3 years in terms of, because the total amount of assets that are going to move into the recovery phase are going to be high.
Yeah. So, sir, just one policy-related question, Sunil, for you, and a view on that. See, what we have seen emerge, whether it is the IBBI regulation, whether it is the way the courts have behaved in NCLT, or where we have even look at the RBI in terms of the June 7 circular, we have just become, we want to do resolutions through a compliance mechanism and not through a commercial mechanism, which requires increasing the enterprise value of the company for better recoveries. You look at NCLT, for example, you admit something and within 90 days, you need to run a process to sell it without even any provision to say, how do you increase the enterprise value to even sell it? So you end up leaving a lot of arbitrage for somebody else to actually come and create wealth. And we've seen that in Alok Industries, and we've seen that in many of the other companies or Patanjali of late, where a significant equity value has been built out and the lenders have effectively taken haircuts. This is not only NCLT format. It's happened in June 7. It's happened everywhere.
I completely agree with you, and that is taxpayers' money. It's our.
Why
It's
does
everybody.
regulation evolve
Yeah.
to talk about a commercial build out? We've attempted in ILFS by actually putting some assets in an InvIT. So I hope that will work. But I'm just saying, at the end of it, we don't have any such mechanism or any such guidance.
You know, Abhijit, as you have seen yourself, and we've got Sanjeev from SPI as a co-panelist, that in many of these, when we've gone through a crisis of the nature that we did in terms of the amount of assets that went into stress asset situation, the pendulum swings the other way. That even for the best reason that you're working on a commercial basis to get the right value, but if you don't comply and tick all the boxes, you are very fearful of a look back down the line. And that gets into a witch hunt, because what seems sensible today may not seem as sensible 2 years, 3 years down the line. It may seem completely outlandish in the way we've sort of dealt with it. And I think that's really the issue, that we have stopped believing in the decision making of officials who are involved in this. And hence there is a kind of a pullback. And at the same time, Abhijit, you named it, that there are people taking advantage of all of this. So people actually are in a situation where you've got to kind of define the fine line, that this is where, from a compliance perspective, I will follow. And this is the flexibility that I have to enable this asset to move into a process of recovery, or into a new AIF or an AMC or a ARC to sort of take things forward. So this is an unfortunate, and we had discussed this with the earlier finance minister at length when we were on the SBI board, Mr. Jaitley, that we just need to allow this to ease off and allow decision making to become much more commercially oriented. And but at the same time, we should not allow that this should, as I keep repeating, that anyone to take advantage of the infirmities that exist in the current system.
Thank you, Sunil. Sorry, paucity of time. I'll quickly move to Susan. So again, sticking with the theme of credit growth, do we think we need to see more avenues of banking being done differently? There is the whole digital phase that's coming about, and data is going to play a very important role. The fact that should corporates be allowed into banking to basically able to expand domestic balance sheets? Today we are actually stuck with a situation where we're not allowing a foreigner, unless you are a wholly owned subsidiary, to actually come and set up a bank or invest in a bank. So you can have a large private equity firm come and say, I will go turn around a bank. We have a lot of opportunities that IDBI on the stake, on the sale right now. But you will not allow a large private equity to come and say, I'll turn the bank around, because RBI will not allow a private equity to take a majority stake. So we are left with only the corporate world opening up to banking. So your views on what are the avenues that we can use for credit growth, for privatization of PSUs? Possibly if you think that's required, because that is 70% of our balance sheet. And how do we revitalize NBFCs?
Thanks, Abhizar. That's a really tough question. Thank you, Niti and Nidhi from ISPP, for having me on this panel. I think I'm the only non-financial market participant on this list, and so it's a tough call for me. But I will take on the economist role, and there was an interesting context that Abhizar set for us. And I think that what Sunil just mentioned is extremely relevant for the question that I hope that all of us are really focused on, which is, how do we get credit growth back on track, right? So we had terrific growth 3 decades and 2 decades ago, and the last decade has been a complete problem. And of course, there was an amalgamation of whole lots of issues that happened. But if we think about it from the point of view of credit growth, then one of the features of India that is reasonably constant across this entire period, that is that credit flows largely through very large financial service providers, right? It's only very recent that the kind of platforms that you're referring to, Abhizar, have come on track, and they are targeting a very different set of participants or borrowers compared to what we think of, right? So in your context setting, you talked about how we are a country which is growing so fast that we have extraordinary demands or requirements of infrastructure. That is not what's happening through the fintech platform. So, it's kind of like a two-part problem, and one part is being serviced by the fintech. But the old traditional model of the financial service providers like banks and more recently NBFCs are what is really the crux of what we need to solve when we look at credit growth for this fast growing country as we go forward. So there are many elements of what you said and what Sunil just spoke about, which I think is critical to look at if you're looking at it from a forward looking perspective, or how is it that we can get credit growth back on track, which is that something happened to the banking sector and the economy in the last one decade, which, as you pointed out, was completely different from what happened before. And you mentioned that somehow India seemed to have been protected from the entire global credit crisis of 2008. And that is true when you look at it from the lens of the credit growth of banks. But if you were looking at the balance sheet of the firms to whom the banks were lending, that was a completely different story, right? So from about 2010, 2009 onwards, the fixed asset build up, the profits, the sales of all of the largest firms in our country, which is, think about the manufacturing, non-financial firms, non-oil companies, right? The big listed guys who were getting most of the credit, they were crashing like crazy. So their balance sheets probably were tremendously over leveraged because they were able to get access to liquidity both offshore and onshore. And that leverage was not something that they could manage, and things were going off or awry. Now, our banks were the ones who were lending to them in part, and for some reason, this downslide of the manufacturing sector balance sheet was happening much faster than it caught on to the bank's balance sheet. And so we see that from 2011 onwards, the banks are withdrawing from lending to these very large corporates or the corporate sector in India. And probably because they were seeing that there was something going on, which they were not able to, which was not coming out in the public in a very visible manner. So the banks stopped lending. And if we look at the credit growth of the banking sector, all the way from 2011, it's been recorded that there's a dramatic shift away from lending to corporates. And today, if we look at where the big credit flush is going, it is going into retail, individuals, for consumer credit products, right? It's not for corporate sector. So this is where we need to pause and think to ourselves, how is it that we can get the banks back on track? And for a while, the NBFCs did step up, that they were tapping into the liquidity from the banking sector, but they were also able to raise money from the bond market. And a combination of this made them viable lenders to the corporate sector in India. But those balance sheets weren't growing, and we had this crisis which started from the Divan housing and the ILFS crisis. I think it was 2017-18. You will know this better than I. And then they also became a source of liquidity that just, or credit, which just vanished. So now we are really in a hard stop. And I think that if we need to get back on track, we need to understand how to solve two problems. Number one, there was something that happened, as Sunil just mentioned, right? That the banks capability of assessing risk, credit risk, made a shift in the last decade. And the question is, perhaps it was because we were such a fast growing country, there were new risks that were coming into play, and the banks need to rebuild the capacity to assess credit risk. And one question that feeds into your policy question is there some policy element that can help build that stronger? And perhaps it goes back to Sunil's second point about governance, that when you set up an organization, which is a bank, and there is a credit committee that's taking on the assessment of these projects that they are lending to, there needs to be a protection or an understanding that every loan has got some amount of risk, which means that some of them will go well and some of them will go badly. And even if you think about recovery, which is what we were talking about in the previous session, it's not like recovery will necessarily be a fantastic number, but the whole point is to recover, restructure, or liquidate and get out of it, because we need to redeploy capital if we want to start thinking about credit growth. And so the elements that we have been thinking about in terms of both how do we give confidence to the banks back, or banks, and I mean as banks as the front contenders of the big creditors in the country who are getting the savings of the investors and they need to deploy that credit back. Number one, how do we get policy to think about understanding credit risk a lot better? Can we have better bond markets? Because that's the way that it usually happens globally, that you have other instruments, other platforms like exchanges where you trade bonds. Bonds have credit premia, and those tell us something about the credit risk. But we in India do not have a very liquid market. We do not have instruments like CDSs, that is the corporate debenture, derivative swaps, or those kinds of instruments.
Default swaps.
Yeah, default swaps. Thank you so much. Default swaps, which help us understand the risk of those instruments and lay them off. So that's a missing segment in our market, which can help banks understand the risk of various loans that they are making. And the second part is, what are the kind of legal or regulatory instruments that we can put in place to help us recover? Now, both of you have mentioned the various slew of attempts that were done, both in terms of the Reserve Bank as well as laws. So Reserve Bank has regulations, which is provisioning as well as credit risk for the kind of loan defaults that are happening. And the other part is legal instruments like the IBC, SARFACI, and the like. And the SARFACI was something that gave some amount of relief in terms of recovery on bad loans, but they tended to be on mortgage loans. So if there were that kind of loans, there seemed to be some recovery that was good. But for the rest, which is the large infrastructure projects, SARFACI did not work, and that is truly the crux of the matter. If you were thinking of, if you're thinking about what will it take to release credit growth to go into the future, I am not as pessimistic, I think, about the scenario of needing to have a big focus on recovery. If we say that we would need to understand what's happening to the big lenders, right, which is our banks and our NBFCs, we do some analytics which look at the traded prices of all of these listed. And so banks are nice because all banks are listed, the large NBFCs are listed. And we have these metrics that allow us to look at the prices of these, the shares of these firms on the market. They're quite liquid. And what we can calculate is a measure of risk, which is called the distance to default. And because these banks and NBFCs have been listed for a very long time, we can see how the distance to default has been moving for the last decade. And if you look at the banking sector or the NBFCs in the first half or even most of the last decade, these numbers are very close to zero, below zero. And what we think of as a healthy firm is a firm which has a distance to default and at any given point in time of anywhere above 2. I mean, technically you can say even above 1, but these are the kinds of ranges where we think about healthy firms. Most of the banks in the country have had the distance to default below 2, several of them below 1, and some of them even negative. The good news is that in the last quarter of 2021, a lot of these banks have started showing a nice growth upwards of their DTD. So it looks like for the large financial creditors in the country, they have been over the last 5 years cleaning up their balance sheet, and the market's assessment of the strength of their balance sheet, the amount of hurt or harm or NPAs in those balance sheets has been coming out saying that they have improved in the last 1 year as compared with say 5 years ago or 4 years ago. So the story that we are seeing from these numbers appear to be that the big creditors are starting to clean up their act. The companies are starting to deleverage. All of them have seen probably a drop in the size of their balance sheet. By and large, I'm not talking about specifics, but the whole sector as a whole. And they are coming back to track in terms of some semblance of being healthy again. The real question is that they're healthy, they have the money because they're getting the fixed deposits. The question is, what is it that they're doing by way of credit? And that's the story where we are stuck, right? Because they are healthier firms, they are able to lend, but they are not lending to the corporate sector. And the corporate sector is where we need to see the credit starting to move into if we need to get back on the growth story. So I don't think that I have any challenges. If putting on my public policy hat, which I really don't have because I'm just a mere economist, the sense is that if we look at this as asking, what is the market failure? Why is this not happening quicker? Right? One part of it is, as Abhizar, you pointed out, there are regulations, there are constraints on who can become part a bank or take on the NBFC as a creditor role and start building up the number of entities in the space, which could be one way of increasing credit flow into the economy. I think the constraint will be that we know what can happen when a bank goes out and makes a loan, and it can cause a big, heavy tax on the public funds of the country. And this depends upon how well the banking sector is regulated. If we do not have good regulations, then this problem is likely to happen again and again and again. And we've seen this all the way from 2000 onwards to today. There have been several episodes where banks, which are the most regulated entities in the country, have gone through ups and downs. And there have been bailouts of all kinds of different sorts. We still don't seem to have put our finger on good and sound and reliable banking sector regulations or banking regulations. In such a regime, to allow a corporate entity to become a bank or to open up the space of banks, a banking license to a very large set of players, the question is we should be a little thoughtful and careful, because at the end of the day, this is in customers' funds that are being given in good faith to the banking sector. Or today, the NBFCs are also regulated entities. They can take loans from the banks. We need to put our focus much more into strengthening the ecosystem that can allow us and our large creditors to go out and lend in a much more reliable and safe manner. Some of the ecosystem that we discussed at the start of my talk, which I mentioned, like a liquid bond market, or to have derivatives instruments to be able to hedge risk. These are some of the things that we really need to think about before opening up the space to many more banks. And that's what I would place on the table before stepping off.
Sure. So then just a few observations, being a practitioner of sorts. One is, and I won't offer an opinion, I'll just mention some of these things. One is, we've seen a steady retailization of our banks. So we had 3 large infrastructure lending specialists in this country. There was ICICI, there was IDBI, and there was IFCI. IFCI is near defunct. IDBI is so-called privatized, but into retail, and ICICI is a retail bank. Now, we have lost the ability to assess project finance over the last 20 years. The only credible assessor of corporate finance, of project finance in this country, is a division in SBI called PSFBU. And I think they are about the only one who really assess credit. Everybody else just piles on them and says, if they are giving it, we'll give it. Sure. So that's where our expertise lies. Sure. And we're going to have the National Infra Bank, which is hopefully going to build that expertise to assess infrastructure. Our problem has also been in India, as against the West, is that sometimes our credit risk sitting in our infra projects are not really controllable by the bank. It's about political approvals, it's about agitations and things like that, which are quite outside the balance sheet. And it's impossible for a credit to price or forecast this into a quality credit decision, is what I feel. Now, do you think that the infra bank as an initiative, should they actually build expertise to actually underwrite credit risk and be some kind of a first loss provider to actually offer a AA or a AAA instrument to the rest of the banks to simply fund? I mean, why the hypocrisy of saying, let SBI underwrite and we'll underwrite it on a pari passu basis?
Abhisar, I mean, when I think about it, and this is just my knee-jerk reaction, is that the only difference that I can pick up, and I'll have to think a little more deeply about it to see more, is that there are 2 separate entities. One which is explicitly doing it versus, in your example of SBI, the division at SBI, you have to be in the know to be able to know what they're doing, right? So
but they have that expertise.
So of course, right? Because in a marketplace, everybody, especially a marketplace that's small, our marketplace has got fewer entities, and the country of our size should have a much larger bond market or a loan market as compared to what we have. But given the givens, the thing is, in a small market, everybody knows what everybody else is doing. And whether you have it being done only in a department of SBI versus a separate entity, my sense is that the dynamics will turn out to be the same.
No, but something what you're doing as an SBI, as PSFBU, let that be done by the infra bank with a first loss guarantee. Say for example, if the net credit loss in the system is 20%, let them do a first loss guarantee of 20%. Then everybody else is just issuing a AAA instrument.
So, but
Okay.
here the question, I guess, I'm sorry, Sunil, I'm just going to say one last line before I shut up. There is a cost to setting up the organization that that you're talking about, which has to be borne by someone. And the question is then everything that Sunil mentioned by way of governance, setting up the organization, making clear the links and the guarantees is something that we need to worry about, which my sense is that's a big kettle of fish. And most likely continuing the way that we are doing is the cheaper alternative, and a cost benefit analysis will probably show it to be so. But this is just my instinct, and I'm sure Sunil will know better.
So I know Sanjeev is waiting patiently for his turn to give his views as coming from the largest bank in the country. But I'll just take a minute to what you just said, Abhizir, in terms of the infrastructure financing institution and the first loss guarantee. I think to get credit growth really kick-started from here is we need multiple solutions. The kind of capital, if you look at a 7 to 8% GDP growth, the amount of financing that is required for India's infrastructure to keep this growth going, one institution providing 20% guarantee, I don't know where you're going to get the capital from. So, and that is really the big issue. So the aspect is that we've got to start completely opening this up and saying, how do we open up different streams? You have this institution coming up, you should have more institutions coming up, you should have the credit default swaps, you should have a vibrant asset trading platform wherever there are the debt markets sort of to make it vibrant. You should have, how do you remove away information arbitrage from a debt perspective to enable market participants to invest in these. Our insurance companies run under one, they've got long-term funds. They run under one regulatory architecture. The banks run under a different, securities regulator runs under a different. We started this, where is there a cohesive approach that they're thinking about together? So I think we need a much better framed regulatory architecture now. You cannot have silos. When we looked at the 2008 financial crisis, the Financial Stability Board came up with what was the genesis, the systemic risk. We have not done much in attending to those issues on regulatory front. And I think in India, we should be taking the lead now. If you're looking at if we're going to build this economy, our regulatory architecture has to become far more contemporary. And we need to sort of start looking far ahead in terms of sophistication of market products. And insurance, securities, pensions, they all have to move in tandem. And then we have this whole aspect of the new elements that are there in infrastructure about sustainability.
Right.
All those projects that were viable earlier on a climate and a sustainability platform, you've got to look at this new aspect of which project is going to be, financed or will find financing as we move forward from here. So I think the big aspect is that this is a big project that we need to have a thinking across the board on our regulatory architecture, and policies need to work together. And it is not just one bank or a few banks that can get the credit, that they're afraid of lending. They're not afraid of lending. They want to do now sensible lending to be able to deal with all these issues. And they have their fiduciary responsibility towards their stakeholders. So I think this is where the issue is. We have got, all of this has to move in a much more synchronous fashion to be able to kind of kickstart the economy. Don't depend on just the banks, and don't sort of feel that they are holding back. I think they are not holding back. Wherever a project seems to be sensible and viable, I think they're sort of still going out, but they don't want to repeat the mistakes of the past.
No, you're right. I think both you and Susan are right in the sense that if we have a liquid market, then the maturity issue will go away.
Yeah.
Because frankly, there will be liquidity in the market. So we don't need 25-year-old money sitting in a bank. The bank will have a more liquid market available to manage their balance sheet. On the other hand, I must tell you that, on the synchronicity of regulators, we have the insurance regulator, for example, which has long-term funds, but which invests only in AAA projects. So we'll never get those funds accessed to infrastructure because you will never have a single infrastructure project which is AAA. And when you try and make it, I've had this real experience, where you try and make it into a AAA project by putting it in an SPV. Because the SPV is less than 3 years old, LIC can't invest. I've had that problem. And then we again went back to SBI to get it financed. So, there are pools of capital. There is the pension pool of capital. There's a life insurance pool of capital. But, we're not able to access some of the capital also. You're right. So
we need to build a regulatory infrastructure. And I think
agree.
that is absolutely critical.
Absolutely.
So there is a proposition that has already been placed, and I will dwell on it on a different platform.
Sure. So, Sanjeev, coming to you, I've interacted with Sanjeev, more known for his NCLT related issues, but I will take him away from there. Of course, he can comment on NCLT whenever he wants, because SBI has had the maximum experience in terms of resolution related experience. But sir, I have a different question for you. When foreign banks were allowed to set up wholly owned subsidiaries, there was a saying from RBI, there was a note from RBI which says that we want to give foreign banks a level playing field. And a PSU chairman commented to me, what about level playing field for PSUs? And we are 70% of the banking system. So my question to you, sir, is that how do you see private sector, public sector banks evolving from a governance point of view, from an operating point of view? How do you think they are going to be able to deal with this whole privatization issue? Are they likely to get privatized fully? And what are the issues around it? What regulatory changes we need? What regulatory changes we need in terms of them operating more efficiently? Because I do believe that there is a lot of talent here. But unfortunately, the constraints are bigger.
Thank you. Thank you, Vijay. And thank you, ISPP, for having me here. So some very interesting suggestion, I think, from Mr. Mehta and Susan. So I will just say, basically, Indian banking has evolved. If you see in last 20 years, there has been, I think, 3 cycles we have seen. Immediately after the 98 and 2001 crisis, we see one cycle. Then after 2008, and then again recently due to COVID. So we have seen this up and down. So I think this is for any credit person like me, this is a good experience of understanding the market, how the market behaves. And what I have seen is that Indian banking is going into an area which is very different from the way they have been trained so far, like coming back to credit. So if you look at Indian banking, history of Indian credit, I see it as more trust-based than credit analysis-based. That is my sense. So we were putting in a lot of trust in these large business houses like Videocon, maybe Reliance, ADAG, some large groups, Bhushans and all. So it was less of a, I think, analysis, more of a trust that they will succeed. Then there was a euphoria. If you see the time after this 2003-04, when Vajpayee handed over the government to Mr. Manmohan Singh, India was about to take off, and it was really the good situation India was in. It was a very, very sweet spot India was in when the entire world market was booming. And we had the basic fundamentals in place, like good roads, good electricity act, a lot of changes. The SARFAESI Act came in to enforce your securities. A lot of changes, policy inputs came in, which created a very, very good market for the banks. And that led to a exponential growth in the credit in those years from 4 to maybe 8 or 7. The growth was so exponential that at times it was 30 to 40, 30% growth in credit over previous year. Whereas the economy was growing at 7 to 8%, and even in nominal terms, maybe 14, 15%. So you are having a growth of double the rate of economy. That, I think, as a banker, I don't think it was a very sensible kind of banking. You cannot throw money at the market, or you cannot grow faster than the economy. So banks were giving credit, and with the confidence that most of these borrowers who are in infrastructure space, who are in many other, they were like building capacities in a breakneck speed. So they will come and see, and they will give us good returns. And then came the crisis. And you see how we handled the crisis. Mr. Reddy, that time RBI governor, will claim that I handled it perfectly. Not a single Indian bank failed, and it was no crisis in India. But actually, if you go deep into it, you see many of our corporates who were over leveraged. For them, suddenly the cost of funds went up. They went back to the banks with a bowl in hand. They said, "You do something, otherwise I'm not able to pay." Most of them were restructured through CDR or any other mechanism. This was the period I am talking about, 8 to 10, and everything was hunky-dory. Suddenly, the moment these people, again, the repayment date came for the restructured debt, again they came back on the table, because the underlying business model had collapsed due to the international crisis. What actually we tried to do here was that to solve a debt problem through further debt. That was the fundamental failure of Indian banking, that we tried to solve a over leverage problem with giving more leverage, more debt to this company, without actually thoroughly or deeply restructuring this debt. I have done many CDR kind of transaction, and I can tell you, none of the bank was ready to take a single rupee haircut. They say, I will give you some money under CDR, and that money will be used for repayment of interest. That was the general thinking. We will not give you any cash. That was the general refrain. Not from SBI. I'm talking about many other banks. I was pushing for, in some of my accounts, I was pushing for that, unless you give this gentleman some cash, how will we survive? You have to provide him some liquidity. But the refrain was, no, we will restructure the account, we will save it from NPA for 2 years, and then whatever additional funds are given, that will be used for servicing the debt. That was the situation, and that's what everybody knows. Not that I am only telling you. Then came 2010-11, all these people were again on the table, and actually their fundamental model has failed. So IPC was required somewhere around that time. So it would have been the right time to introduce IBC, maybe sometime in 2009 or 10, which I think came, say, 5-6 years late. So again, these were on the table, and again some more schemes, as Mr. Mehta and you also suggested, that those SX4, then your other schemes, whatever you name you call it, they were tried, tested, and all failed, because nowhere the kind of haircut the banks have taken under IBC that was available. No bank was ready to take. That is one part. Second part is that since we as bankers did not have any resolution mechanism which was effective other than SARFAESI or DRT, which everybody knew that these are only effective mechanisms for small companies like MSMEs. You can use SARFAESI or DRT for MSME, fine. 50 crore debt, 100 crore debt, okay, I can wait for, say, 10 years to get a judgment. But for a company of the size of SR Steel or Bhushan Steel, you cannot apply SARFAESI. Neither are there any collaterals, nor you have any resolution there. You will only take it to some, you lock down the factory, and then it goes down the drain, you recover nothing. That was the another handicap banks were facing. So they kept on evergreening these assets. That is where now many people are shocked that why this company like Videocon got so much credit, or some other companies also. It was basically nothing, because the value of assets kept going down, but the value of the loan kept going up. Now, third thing which I think IBC has helped us, that many of these companies which were basically zombie companies, and I think I can name those 48 now, which are there in the RBI list 1 and 2. Actually, they were zombie companies which were running on the continuous supply of cash from the banks. they were spoiling the entire market. So even if one company A has a good business model, is efficient in his approach, but suddenly company B in the same business, say steel, what the company B is doing, they are not paying interest to the bank because they are NPA, they are a defaulter. At the same time, they are supplying goods to the market. So this company has an advantage of 10 to 12% of interest cost. And they are also, because they are NPA, they stop repayment of principal also, additional advantage of maybe 10 to 20%. These companies make these efficient companies also zombie companies or insolvent companies. That has been going on in India for last maybe 20, 25 years. Okay, we have not seen many companies, zombie companies going out of the market. Somehow they have managed to survive under BFR, then under CDR, and then later on also through some kind of restructuring, but they were basically zombie. They were failed businesses. We survived. I'll give you the example of Air India. Okay, Air India, government company, many of the airlines failed during, like, right from Jet Airways to Damani Airways, like in a queue, many airlines failed, but Air India survived because Air India had unlimited coffers. Government will supply whatever loss. Ultimately, you see a situation where today, when Air India has gone private sector, suddenly other airlines will find them in profit. They'll survive for longer term. They have a better margins because they don't have a competitor who has like deep pockets. So airline industry will become, so that is the other impact of bad credit or an insolvent company running as a running company. That fourth impact of that is that when these companies go out, the other companies become more efficient. You see the impact on our exports. This year, despite COVID effect, our exports have grown to almost 650 billion, including service exports. It is almost a substantial 50% jump. Why? Because now your businesses are getting efficient. So these are some of the challenges. Coming back to your question, how can we increase credit and improve our, I see 2-3 weaknesses because last 10 to 12 years, not many banks have really done any project funding or any real large cap funding. See, we are only doing restructuring last 12 years or 14 years. On 2008, I don't see much of a large project funding, any big steel plant being set up or any road sector. Most of the funding we are doing are just restructuring, rescheduling the asset. That's all. So actually, most of them banks have lost those people who were the credit hands, who were really experts at assessing these loans. Those who are there, they have most of them become either CGMs or DMDs. They won't be handling the account as a desk officer or an analyst. Okay. Others may have retired. So that is a big challenge coming, including State Bank, every bank, that you don't have those kind of people. Because last 14, like I say, last war India fought with Pakistan was 1999, Kargil war. That was after 1971. Okay, 29 years. So many of the officers, they have never seen an action on the front. After 99, again 23 years, many of our soldiers have not seen any action on the front, other than that Chinese border, some small 20, 40 people there. So these people who enter the army or air force, they retire without seeing any action on the ground. That is happening to banking today. We have not seen any action in last 14, 15 years in credit. So now when the credit demand, which of course, as Susan said, I'm also very optimistic, it will automatically come because it was a matter of over leverage of the zombie companies, which I think IBC has contributed. They have gone out of the market. Now new people have incentive to go to the bank. Banks have incentive to lend. Another important thing is that because of change in business model, because of IBC and other factors, new type of people are coming in, new type of businesses are coming in. They may not require bank funding at all. Like you see 45, I think, startups, they became unicorns last year. They have not come to any bank for funding. They are already a 1 billion company. So those kind of business will appear. So banks really have a challenge.
On a lighter note, some of these unicorns don't have a cash flow.
Yeah, whatever, but they have the money. So they have no dearth of money for which we are ready to fund.
For the time being, Mr. Sanjeevji, for the time being, so they will come to you at some
stage. They will come.
Yes, they'll come. So I see very positive thing coming in very positive future, only except that we should either outsource for this kind of lending, because banks will find it very, very challenging getting and finding people for that. Even if you promote people very fast, make them DGM or GM within say 10 years or 15 years, but the banking you learn only through hard way, through failure.
Absolutely.
Best teacher is a failed loan or a failure in life. That is my sense. I have learned credit by making maybe 2-3 bad loans and then learning, and then seeing 3 business cycles, how my loan featured and ultimately survived in 3 or 4 cycles. That is how you learn credit after 15 years of entering the credit department, not immediately. It's not a ratio analysis only. It is you see what you have done and what is the end result.
But sir, you then emphasize an important skill building requirement.
Yes.
That will be done now if you want to sustainably do good credit.
Yes.
I mean, with acceptable levels of losses.
And then another good positive I see is the IBC, which is teaching us the basics of credit. I'll tell you, now we are understanding what is the actual meaning of a personal guarantee. We have been taking personal guarantee since ages, but today we know what is the real value of a guarantee. So far, we just used to take it and just file it. But now when I'm filing personal insolvency cases, I'm really trying to find out what are the actual assets of the guarantor. How can I enforce? What is the real meaning? What the Supreme Court is defining the guarantee now. Similarly, default, so many basic things, mortgage, everything is getting tested in the courts. And we are relearning the credit. So these are some...
IBC actually brought about a very significant possibility that there could be an insolvency situation, which in India was unthinkable.
Yes. There was no insolvency. See, we used to see that insolvency ratios like debt equity ratio, but that was just for the sake of it. Nobody has seen a real liquidation or a bankruptcy, other than like company going into that winding up.
Yeah, which takes years.
Now that is a elephant in the room, that within 1 year of giving a loan, the company can enter insolvency. So these kind of concepts have been clarified. So I think good learning, and I see a lot of positives here. Only if banks could create a specialized workforce, because right now most of the banks have a system of moving their offices around all the places, like from retail banking to corporate to forex to social banking, all kind of things person does, but he's not a specialist of anything. But now is the time that, as I am the specialist for IBC and SBI, so banks should follow this kind of practice, create a specialist for everything. Then you will have better, and then also seek outside support. Like we have a lot of intellectuals, a lot of experienced people getting out of this steel authority, maybe Indian Oil, but a lot of good officers who can give you real insight about the industry. So bring them in on your board, credit board, so that they can give you a real input to how this business, what are the inherent risks. Like NHAI, you may be having some retired officers, they can tell you what are the problems in the agreement. Similarly, NTPC, they know how to sell, how to set up a plan. So these kind of people are available in the market. Why not bring them on the bank's panels so that they can guide you, give you some specific expertise on a particular loan proposal? Why only depend on your in-house expertise? No, that is not the time. So these are some of the sessions. I think growth will automatically happen. Only thing, as Sunil Mehta ji rightly said, we cannot just recklessly lend anymore. Today, that concept of FACR, I keep telling my people, because we used to assess the loan security through FACR, fixed asset coverage ratio. Okay. And most of the time, our people were happy. I am having 125% fixed securities against my loan. Say 100 rupee loan, 125 crore asset. Today, when I went, that company went into insolvency, that asset was sold for 17 rupees. So I lost my entire hair, not only haircut, entire one ball.
Head.
So that learning has come from only IBC. Today, I see the market value of assets. What I feel is a good security is not actually a good security. So that is a market is giving me some market values, some standard. Like I can value a steel plant today by benchmarking it as SR Steel or Bhushan Steel. These companies, 1 billion ton means maybe 6,000 crore. Till last year, I had no benchmark.
Agreed.
Similarly, for power companies, we were maybe funding them at 5 or 6 crore per megawatt. Today, the benchmark has come down to 1 crore per megawatt. That market is giving those benchmarks, which are very, very important for any credit person. So these are, I think, very good positives of this market-oriented process. And we are going to have competition, I think the best regulation could be that first you I think accelerate the adjudication process. That is the biggest dampener, because if you want to have good credit, you should have good courts and enforcement of contract. Unless you have that, we will be ending up, because people will use this lacuna as their advantage, especially the borrower. Second thing, good thing has happened that our professionals are now tightly regulated. That is a very good contribution of this government, because I see many of these pitfalls because of bad balance sheets, bad kind of figures coming up to us, and we are depending on those balance sheets. Now, at least whoever is signing that balance sheet, he is responsible. He can be put behind bars. So some kind of semblance, some kind of discipline has come in there. Then we have GST. We can look at the numbers. We know what are the real numbers of sales and profit, which many were not there earlier. So many of the positives are there. I see a lot of.
So sir, just one controversial topic for you. Do you think the fear of stick actually gets people to behave better?
Sir, I feel I don't believe in too much regulation. What I believe is that regulation of the market. Let market, because we are entering into an area which is too much market oriented. What we should do, like for maximization of value, we should try to bring in 10 resolution plan, not one or two. Like in Videocon, we were having only one plan, and whatever that gentleman offered, we had to accept. In Ruchi Soya, there were only two plans, one backed out. So we should have, and that is what I tell my people in the bank, try to bring 10 plans. And that is the job of the COC members also, not only the RP. Once you have 10 plans on the table, they are fighting with each other, you have the maximization value. Second suggestion for regulation is that I think 29A, some tweaking can be done, where you remove that section 29A, I think C and F. C is just because the gentleman is NPA for 12 months or more, he is ineligible. I think that is not required, because you already have that willful default or other restriction. Second thing, the guarantee given by such person. I think if we remove them, this will make the market more competitive.
Agreed, sir.
I have learned in my 5 years in IBC is the best valuer of a corporate debtor is the promoter himself. He is the best valuer. He knows in and out what is the value of this company. Unless you bring him in, you can never ascertain the real value.
Thank you, sir. Actually, Nidhi, may I recommend that each of the topics we raised today, you can actually have a 2-hour panel discussion on it.
Yes.
These are as big topics. So I will
I really want to step in and pause.
We have exceeded 15 minutes of our time without giving any time for Q&A, but I'll still hand it over to you to take it to conclusion. If there are a few questions, we can even take them, if time permitting, for all the panelists.
We will share the questions to our panelists, and we'll try to get them answered. But yeah, we are over time, so I think we can put an end to this discussion today. Thank you, everyone. Thank you, our eminent panelists, for taking out so much time and this engaging conversation, this discussion. It was an excellent discussion, and I'm sure our audience will take away a lot from this conversation. And I think we would, of course, need more time for this discussion, and I hope we can all come back. Thank you, everybody, for joining us, and we'll hope to see you soon. Thank you so much.
Thank you. Thank you.